Hi, I'm Andrew Wright, Principal of Professional Southport, and this is the Andrew Wright Property Podcast. I've built a multi-million dollar property portfolio, delivering a seven-figure annual rental income, and led my real estate team through thousands of sale and lease transactions. In each episode, I share real deals and strategies that will help you find, fund, and operate profitable property deals. The aim of this show is to provide education and build a community of like-minded investors who can collaborate, share insights, and help each other in each other's journeys. You can make excuses or you can make money, but you can't do both. So come and join us. So I bought 4 industrial sheds on one title on just under an acre of industrial land up at Hervey Bay, an 8.5% net yield after all the outgoings, and over $2 million below the replacement cost of that asset. So I was able to revalue it in about 12 months' time and redraw some extra equity for my next purchase.
Hello and welcome back to the Andrew Wright Property Podcast. Today we're talking industrial sheds and cold storage and why these assets are in demand, what makes cold storage so sticky, and of course Andrew's real deal, this time in Hervey Bay where he bought well below replacement cost on an 8.5% net yield. We'll cover the numbers, the lessons, and the exact moves Andrew would repeat and avoid. Andrew, welcome to the podcast.
Adam, how you going?
I'm very well. Look, before we even start, okay, because I know we obviously have a chat before we get started here. You've got some exciting news from just this week, haven't you?
Yeah, I have. Just this week, I've helped my son and my daughter get into their very first property. So I'm just super excited about that. I've been helping them get educated around property for a few years now. They've both saved over $50,000 in cash at age 19 and 21. But even with that 5% scheme now with the government, their serviceability, just even though they got the 5% deposit to buy $1 million property, their incomes don't even allow them to borrow from the bank. So rather than go down that track, we've just successfully done a joint venture between my 2 kids and I to buy 10 acres of industrial land, and I'm just so excited that I've helped them get into the property market maybe 3 or 4 years before they otherwise would have if they did it by themselves.
Wow.
So the reason I'm just so excited is there's several fold. I mean, first of all, I'm teaching them about commercial property, not just buying residential, hold and hope that the market goes up over time.
Well, this is what we're doing with this podcast, isn't it? And what I love about this is that so many people, when they think property investment, are just residential, buy an investment property, buy an investment. But what you're showing us and teaching us is you can do so much better by looking further afield and into different asset classes.
Well, I'm hoping the listeners to the podcast get the same benefits, and what I feel, I'm really getting a lot of satisfaction out of just not just helping kids, but hopefully helping the listeners here learn about opportunities to make money. And in this particular deal, it's not just a commercial property, but it's a property development site. And we're learning, I'm teaching my kids how to force capital growth on an asset instead of just buying it and holding it.
Yep.
So what we're going to do is we're going, over the next 12 months, we'll get development approval for a roadhouse or a service station and a large truck parking depot. I mean, 10 acres is a fairly big block of dirt.
We know you love your truck parking.
Yeah, and I'm just so excited that I can force some capital appreciation for my kids and teach them that process. And it's not just about finding the deal, it's about how we finance it. Now, we've talked about this before, that banks don't lend on or don't like lending on empty property. I've done a deal on this site and taught my kids the process. We've actually got the seller to be the bank. It's seller finance, and it's a 5% interest rate for 2 years.
Wow.
Cheaper than the bank. And I'm teaching my kids not just to how to become property developers, not just how to invest, but how to think creatively about how to finance a deal.
Okay. This is going to be an episode, isn't it?
Well, we'll do an episode. Unfortunately, it'll take a year to get approvals and another year to build. So maybe in 2 years' time,
But
definitely we'll do it.
You know what I'd like to
Yeah.
do? I want to throw this out there. I wouldn't mind doing a pre-episode. Like let's leave that there.
Yeah.
If you're happy with this, you tell me. You leave that there because I want you to do a short episode on what the plan is, and let's just expand that right out what you're just talking about. Then we'll do a follow-up in
Okay.
12 months to see where, because this will be so interesting for our listeners of. You've gone in, like we're talking about deals you've done now where you went in with a plan. We're
Yep.
talking about one of those today.
Yep.
And then we see the result.
Can I just add one more thing on that,
course,
which the
of
listeners
course.
and my kids will hopefully benefit of? And then the other thing I'm teaching them there is just pure persistence, because I want the viewers and the listeners here to understand that I have probably been rejected more than 20 times in the last 2 years making offers subject to vendor finance. In other words, look, I'll buy this, but I can't finance it. Will you be the bank and become provide the finance for me, and I'll pay you off in 2 or 3 years' time?
Yep.
I've had 20 rejections in a row.
Yep.
And this is number 21.
Yep.
Persistence, finally got a yes.
Wow.
And it's not as though, look, this deal sounds great. How easy is it? No, you got to put in the work. So I've had 20 no's before I got a yes.
Yep.
And I'm teaching my kids that as well.
Fantastic. All right. Well, let's do that. Let's do a two-parter on
Sounds good.
on your first property deal with your kids. Congratulations, by the way. Very exciting. Mate, I got a kid with 50K in the bank too who's only 18, so I'm going to talk to you after the show. Okay, now let's get into it. So, look, I'm excited about this one because if you have been listening, we did do an episode about truck parking and depots, and I've just been to New Zealand for a week, and what did I happen to notice now every time I'm driving around was truck depots, and I never noticed them before. But anyway, today something different, industrial sheds and cold storage.
Yeah.
So let's before we go into the deal that you've done, just tell me a little bit about this asset class. Why is it in demand? Why did it hit your radar?
Look, I listen to 2 or 3 podcasts a day, obviously, and I just kept on hearing so much of the American trend towards industrial real estate since COVID, and the structural change in shopping from people buying stuff online and moving, instead of going to shops through COVID, they started buying stuff online, and that's pretty much forced the demand for companies to have industrial spaces to house all of the stuff that they're selling online. And I think that's continued over the last 5 years, and that move from retail property outlets to these big warehouses that store this sort of stuff has just continued. Very limited supply of industrial stock all around Australia. Vacancy rates are probably less than 2%. And in cold storage facilities in particular, which is refrigerated warehouses where food is kept so it doesn't go off, the vacancy rates are less than 0.5%.
Wow.
So
there's a shortage of it.
there's a shortage of it that keeps rents up. And that's why they're in high demand. And also the tenants in those sort of facilities will generally stay a lot longer because it's just so hard for them to either find another suitable property or to actually go out and build one. It's probably about per square metre more than double the cost of a normal shed to build a cold storage facility.
Right. Well, I'm really interested in breaking this down and talking about, how much you should put into cold storage versus just your classic storage in an industrial shed. But obviously with this vacancy rates like you talked about there, that this obviously makes this asset class have a much higher chance of a reliable cash flow.
Well, absolutely yes, because the leases are typically longer. So when you get you could say cold storage is a very specialised, custom-built facility for a certain type of, food distributor. Might be seafood or meat. In my case, my tenant is Bega Dairy that do milk products. So because of the specialised nature of that asset, generally they'll sign longer-term leases. Most of the leases are indexed to CPI or inflation, and they stay a lot longer. And as I said, the rents are probably about double what a normal rate per square metre would be for a normal shed.
Right. Okay. And how much of where these places are located plays a part in this? Is location a big part in getting a property investment right when you're looking at this asset class?
Well, I think, wherever there's population, there's going to be companies that distribute milk to people, to shops or to people, seafood or whatever. So, look, I'm new to this asset class again. Like I've only purchased this thing 18 months ago, so I'm certainly no expert. But if you've got an existing tenant in there that's on a long-term lease, now that tenant up there in the Hervey Bay has been there for 17 years. I spoke to the guy who actually distributes the milk up there. He'd just taken up an extra franchise area in Bundaberg, which was about an hour away, but he wanted to keep all of his operations from the one big cold storage facility. They're not going anywhere.
Yep.
In fact, I'm already in negotiations with them now to take an extra shed behind that main shed that they're leasing because they want to expand.
Right.
The opportunity there is there's a tenant behind paying $35,000 a year. I'll double that to $70,000 a year through making it a cold storage
Converting it to
facility,
stalls.
and that extra $35,000 a year at a cap rate of 7% probably adds $500,000 to the value of the site.
All right, let's unpack the deal then. Where is this place? Where did you find it? Talk me through the numbers and the how this all went down.
Okay, so first of all, I'll just say sometimes when I'm buying stuff, there's some sort of emotional connection for whatever. I mean, we talked about properties in Ipswich before. I went to school there. This one's in Hervey Bay. I was born in Hervey Bay. So
Right, okay.
Just
so
all of a sudden, when you're looking at deals, some of these little things might just sort of influence you as to whether you want to go a bit further. Obviously, the numbers need to stack up, but I love Hervey Bay. I saw it online. It was not advertised on Real Commercial. Real Commercial gets the dominant percentage of buyers
commercial listings
and transactions.
And you check every single one.
I check every one. I'll look on Real Commercial, but I also check another website called commercialrealestate.com.au, which is run by the Domain Group.
Sure.
And quite often when you get sellers that are not committed to spending a lot of money in marketing, or real estate agents that don't want to spend extra money advertising on Real Commercial, they might actually only advertise it on commercialrealestate.com. Sometimes they even only advertise it on a residential platform like realestate.com. So there's just not as many of the right
who
buyers.
are looking in the right places aren't necessarily seeing it.
So that can quite often create opportunity. And with this particular deal, once again, it was a residential real estate agent that had just become a commercial agent. And my analysis was that either they or the owner just mispriced this property. Now, it was advertised at 8.5% net after all the expenses, which is just ridiculously good deal.
Yep.
It had 4 separate tenants to diversify the tenancy risk. Like, you're not just relying on if one tenant moves out, I still got 3.
Yep.
It was on nearly an acre of
so
industrial
there's 4
land.
sheds. Yep.
4 sheds.
Yep.
The guy spent $200,000 just putting concrete on the land, let alone the sheds.
How long had he had it for?
A long time, like 17, 18 years, something like that.
Yep. Mm-hmm.
But the quantity surveyors report calculated that for insurance purposes, the replacement cost of those sheds was $3.8 million. $3.8 million, and the asking price is 1.6. The net return is 8.5%. There was still a WALE of about 3 years, a WALE weighted average lease expiry. So the 410.
Explain that. I want to take you back to replacement value in a minute. But explain WALE to
weighted average lease expiry. So the 4 tenants there, on average, they had 3 years left on their leases, which meant there wasn't going to be a vacancy tomorrow.
Yep.
They're not that. There's 3 years. If none of them renewed their leases, there's 3 years of rent left to come in on that. So the longer the WALE, the less risk as an investor, because it just means you're not going to have any vacancy.
Sure. All right, now I want to spend a bit of time on replacement value, okay, and what you use that metric for, what you weigh it up against, because it's a big part of this whole deal for you, isn't it? Now,
Yeah.
because as we were looking at this, I was thinking, if your average residential investor, who we've probably got a lot of listeners who are really listening to this to find out about different ways to do things in property, you don't probably think of replacement value when you buy an investment property of a residential.
Well, they
what
should.
is it?
You can apply the same principle to resi as well.
Okay.
And as an agent, as a residential agent, I apply exactly the same principle. So,
Well, explain it to us. What is the replacement value, and where does that metric play a role in your thinking?
okay, every single day I look at deals online, and every single day, if it's a commercial asset, I'll have a look at the income of the asset, what the fair cap rate would be for that asset, and I multiply the income by a fair cap rate to come up with what I think a value I would say it's worth. But every time I do that, I apply a second formula to make sure I'm not making a mistake. I look at what we call the replacement cost of the asset.
All right, because it's never advertised.
No, it's never
No.
advertised, but it's two components. It's what's the land worth,
Yep,
and if I were to build that property today, how much would it cost me to build it
from scratch.
from scratch?
Brand new.
From brand new. So then
Right.
I have a look at the age of the asset and think about how much depreciation may have happened on that building and what's a fair current value for that building compared to replacing it brand new. And it just gives you a metric to make some analysis as to whether you're getting a good deal. Now, obviously, if you can buy a property a fraction, just a little bit more than the land value, you're not going to be paying much for the building. And having that metric and cross-referencing it to the cap rate, just make sure you're not making a mistake when you're buying something, and you make sure that you don't pay too much.
Sure.
And I'll just go a bit further on my psychology, like when I'm buying stuff, like I will, when I saw that one advertised at 8.5% net return, you're getting 2% net on a house probably.
Yep.
When you see 8.5%, it's 4.5 times higher net return. You've got 4 tenants and not one. It just looks so good. So what it's important to do is when you see any property advertised online with a high gross or net return, you've got to immediately go through a little checklist to make sure you're still not paying too much. And the first thing you look at is, okay, well, is there a problem with this property? Is there a lot of deferred maintenance? Do I need to spend 200 grand replacing an old rusty roof?
Yep.
Which means that extra yield is not worth it because you've got to spend a whole heap of money improving the property.
Yep.
The next thing I'll have a look at, is there a tenancy risk? Okay, looks all right now at 8.5%, but are 2 or 3 of the tenants about to move out and you got hardly any return?
Yep.
And the third thing is, quite often you'll find these types of properties that have a very high yield are located in a flood zone, which insurers don't want to insure, banks don't want to lend on. And if you can cross through that little checklist and say, well, it's not in a flood zone, the tenants aren't moving out, there's no deferred maintenance, I'm not going to be up for hundreds of grand replacing or improving the structure. This is just a good deal, 8.5% net.
Yep.
And that's the sort of checklist that I go through every time.
Fantastic. And just on this checklist is available to
I'll make it available.
Yep, to our listeners.
It's up here, but I'll document it.
Yep, I know. We're going to make it available to our listeners.
Yeah.
And all you got to do is go to andrewwrightproperty.com.au, put in your email, and you can get that checklist for yourself.
Sure.
So, why was he selling? You've been through the checklist.
Yep.
Everything's that's ticking boxes, and you think it's been mispriced.
Yes.
Do you ask why they're selling, and how much does that play a role in your decision making?
Yeah, I ask every time, and quite often it's if they're a motivated seller, there's a reason behind it. It could be a health reason or an age issue. This gentleman is in his 80s and simply wanted to retire. So quite often when you get elderly sellers, they may have a health issue associated with it as well. You can ask the question. Sometimes the agent doesn't know or won't tell you, but I always ask the question. In this case, the gentleman just wanted to retire, and for many, many years, industrial property didn't go up at all. You know, he's held it nearly 20 years and it didn't go up a whole lot. And this last 5-year period since COVID, he's seen the prices go up a lot. So he's done very well. It's a win-win for him. And he wanted to retire. In fact, I've developed a good relationship with that guy, and I'm talking to him now about buying another property from him off market next month in January.
Wow. See,
because
again,
the relationship I
was going to say, a lot
him,
is to do with relationships, isn't it? Once you create these, and there's probably another episode in just that and how deals can come about, which again is another reason for this podcast. You want your listeners to come in, join your community, create relationships and see what can come of it. Like-minded people and, win-win scenarios. And
Adam, I'm actually really enjoying it. Like, in all honesty, like, as an agent, we create value for people. In my business, I sell properties, I lease them, we manage them, and that's a good service to the community. But there's tens of thousands of agents like me that are doing that and helping people.
Yep.
It's not that unique, but this episode, this podcast here, I find that it's becoming very satisfying for me. I feel like I'm actually, like, I don't know if it's a higher cause, but I feel like I can help people more. Yep. Because there's not as many people that can teach you how to make money in real estate. They haven't done it.
Look, it's blowing me away.
Yeah.
I mean, and I think for your lay person who does, as I keep harping on about, go into just residential property, this is going to be an absolute game changer for at least get them to be thinking about these different asset classes. So, but look, let's now. So the 4 sheds. Okay, let's go through each one of those. How many of them were cold storage?
Just the one at the front. So I'll put up a little diagram for the YouTube listeners showing the sheds, but it's roughly 500 square metre shed at the front. The second one's another 500, and then there's 2 smaller sheds down the back. So the front shed was rented to Bega Dairy, as I mentioned, the cold storage facility. They'd been there 17 years. The rent was roughly 70-something thousand plus all the outgoings. The shed behind was direct diesel. They're a diesel mechanic, about 35 grand a year rent, and 2 smaller sheds at the back. One's a boat builder, and I can't even remember the fourth one, but he's been there quite a while and quite happy there. So 4 different tenants, about 141 grand a year rent plus outgoings recoverable under the leases, about 30 grand of outgoing. So once again, that's 171 grand of income, 141 rent plus 30 in outgoing. So 171 grand income on 1.6 mil, nearly 11%.
Amazing.
You know, when I see more than 10% gross income, I start getting excited and thinking, okay, what's wrong with this thing?
Yep.
You know, is it in a flood zone? Is the roof about to fall in? Is it tenants? If I can go through that and, well, there's nothing wrong with it.
Well, I'm going to buy it.
I'm going to buy the thing or make an offer on it. I actually I made a sneaky offer. I made 1.6. I offered 1.5 initially, and the agent said, oh, look, Andrew, it's just come on the market. The owner's priced it well. He's not really wanting to negotiate. I just went straight back, okay, I'll do the deal, 1.6.
You'd ticked the boxes, hadn't you?
I knew someone else would pick it up if I didn't, so I acted quickly straight away. Yeah, no worries, I'll pay the 1.6. Give me 14 days due diligence. I want to go and have a look at the place. So I had 14-day due diligence, 30 days finance. I did manage to get a 90-day settlement to give me a bit more time to get the money sorted out. And
which I want to talk about, but just before we do that, going back to the tenants, do you ever go and talk to the tenants before you do a deal?
Part of the due diligence period is to allow you to do exactly that. So,
okay, well, talk me through that. Someone who hasn't dealt with this kind of investment before and has got, What do you do? How do you approach them? What do you say?
Well,
what do you want to know from them?
Well, first of all, you read the leases. So before I drove up 4 hours to Hervey Bay to have a look at this place, I read the leases and I was protected by the leases, but I still wanted to know the front tenant, Bega Dairy, actually had less than 2 years left on a lease, and they're the anchor tenant. They're paying like half the rent of the place. That was the key one. So I had a good chat to the gentleman there who is the distributor of the milk, and he was not the tenant. He actually is a contractor to Bega Dairy.
Yep,
and he's the guy who runs around with all these trucks. He's got a team of people that distribute all the milk and cheese or whatever else they sell, and he didn't want to move. He said, oh, look, I'll be telling Bega that I want to stay here and we're running out of capacity, but if you can provide a little bit of extra cold storage, I want to stay. So he was keen to stay. There was some risk there that Bega would move because they were getting so big there that the storage wasn't quite big enough, but they ended up signing for another 2 years. They had a 2-year option, and they actually ended up exercising that 2-year option. And now at this point in time, I'm already negotiating with them to maybe take the shed behind and
turning that into a cold storage.
turning that into a cold storage.
There's so much to unpack here. All right, while we're on that, tell us about turning an industrial shed into cold storage and the benefits to you doing that rather than keeping the current tenant there, just in terms of numbers.
Yeah, well, I've never done it before yet. This is my first one, but the shed behind, I think the direct diesel tenant wants a larger place anyway, so they're thinking of moving. So if that's a win-win for them and they're happy to move out to a bigger place, I can invest some money. I don't have quotes yet, but I can put some cold storage facility in the shed immediately behind.
Yep.
And put a hole through a wall or whatever for access if I need to. I don't have to do that. There's a common driveway along the side there, but I can double the rents. And as I've mentioned before, if I can increase the rent from 35 to 70, that extra 35 at a cap rate of 7% is probably an extra 500 grand valuation to the property. Now, it won't cost me 500 to put in a couple of cold storage facilities, but it'll go up by 500.
Great. All right. Okay, then. So talk me through finance, because you've come up with some cracking ways you finance certain deals. How did this one play out?
Well, this one was basically selling some more of my crappy share market investments to come up with a 40% deposit.
Okay.
So, and once again, no good stories there about my share market investments. In fact, during the course of that 90 days, that particular holding went down further as well. I've got the kiss of death on them, and I actually had to get a revaluation of another property in Gatton to drag out an extra 100 grand from that just to make settlement happen. So luckily I put a 90-day settlement on it. So
you had the bank do 60%?
60% LVR just with the bank, So 4 tenants, long-term leases. Banks are happy to lend 60% on what they call a lease stock loan.
Sure.
And I just had to come up with a 40%. 40% of 1.6 is whatever it is, 640 plus the stamp duty. Sold some shares, and I redrew 100 grand from a Gatton property just to come up with a deposit.
Great. Okay, so all the numbers stacked up. You've been in, you jumped in fast.
Yep.
Made it happen, knowing it was a good deal.
Yep.
Spoke to the tenants, realised you had some security there.
Yep.
Looked at the option of potentially Bega taking on a bit more and making some more gains there. Did anything go wrong with this one?
Well,
or were there any challenges?
Yeah, part of the due diligence, obviously, I did spend $1,500 on a building and pest inspection. That'll come back all clear. He said, look, there's no major maintenance with this property. What that building inspector probably didn't have is a lot of expertise in cold storage. So now, 18 months down the track, just in the last 2 months, I've actually had to invest $46,000 on maintenance on these cold storage facilities. So I don't understand refrigeration or anything, but the wording in the quotes and the invoices is that I had to replace the condensers and evaporators in 3 of the 5 cold storage units that I had there. So whatever that means, it cost me 46 grand. So that's a capital expense, even though the tenants pay outgoings. It's a capital expense that just comes straight out of the bottom line from me. But, in the big scheme of things, if that tenant's going to stay there another 17 years, they've been there 17 years already, it's okay. And I had that property revalued after 1 year.
Well, this is what we're coming to now, isn't it? This was so
I bought for 1.6. Heron Todd White revalued it after 1 year, 300 grand higher, almost 1,890,000. So 290 grand more was the valuation, and I've just got an extra 200 grand in the bank last month, ready to go for something else because I revalued it, and the bank give me another 200 grand.
And that's there ready for you.
Yeah, and it's very hard for me to
deal.
save 200 from working as a real estate agent. You got to make commission, you pay tax. Like it's just so hard to save money. So, it's it can enable you to move on quickly.
Was that your initial plan when you did this 12, 12, it's 18 months now, but when you was to revalue that?
Yeah,
Is that how you went into it thinking? Yep.
Yeah. Yeah, so there's no value add with that property. Like I wasn't developing anything. I wasn't building an extra shed. I wasn't adding value to it as such. It was just a good deal. But I knew it was such a good deal that
it was
if I
already
revalued
being used for its highest purpose.
Yeah, I bought the equity there. I just bought it well. And, so again, sometimes you don't, if it's a really, really good deal, it doesn't have to be value add. If you just make a good deal, there's equity built into it.
We've talked about highest and best use, haven't we, a couple of times, and this one, it was already being used for that.
Yeah, that's exactly right.
So again, a different type of deal where that's already there. That's again what I love that we're covering here. So many different, different scenarios, and you looking at it differently and playing that out. So, look, before we finish up on this, is there anything else you'd like to add about industrial sheds and cold storage in this particular deal? Yeah,
look, I'd just say, like with that particular deal, I spent $1,500 getting a building and pest inspection. I also spent $1,000 getting a quantity surveyor up there. Quantity surveyor does a report for your accountant on how much depreciation you can claim, and I'll whack this up in the YouTube section here. But year one, I'm able to claim $68,000 in the first year alone, just in tax deductions on depreciation. Mainly of the cold storage facility. They can depreciate a lot more than the actual warehouse. But that means the first $68,000 of rent I get this year is free of tax.
Wow.
Like, it's pretty significant if you understand the tax legislation. Massive.
Wow.
Yeah.
Fantastic.
So 8.5% net yield, and the first $68,000 is tax-free.
Tax-free. Wowee. Fantastic. All right. So, look, I want to finish up by letting our listeners know that you can jump onto andrewwrightproperty.com.au and get his checklist, which is absolutely free. Just give us your email and we'll send that out to you. And it's a great way for you to start to understand what you need to be looking for in these type of commercial deals. So jump on, grab that. And look, if this has given you any ideas, follow the show and share it with a mate. We're here to help. We're here to show you that property investment doesn't have to be residential, and that there are opportunities out there everywhere in the commercial space, which is what Andrew specialises in. So look, do join our community. That's what this podcast is all about. Jump in, give us your email. You'll get emails from us. You can contact Andrew directly. This is about like-minded investors getting together, having a chat, helping each other out, and enjoying what you do in terms of and making money along the way. So, Andrew, thanks once again. Can't wait for our next episode.
Thanks, Adam.
Look, it's not too far along where you're going to start bringing in some other guests and sharing their experience
so after
as well.
Christmas, I'll start inviting a few other people, so that's not as boring just listening to me. We'll get some other voices
It's
on.
far from boring, I can tell you. But look, that is another thing. If you are a property investor, if you have been out there and doing things and would like to reach out to talk to Andrew about potentially being a guest on a show, there is another spot on the website for you to do that. So please do get in touch. But Andrew, until next time, thanks very much.
Thanks, Adam. Thanks for listening to the Andrew Wright Property Podcast. This is all about building a community of like-minded investors who can share real-life stories, experiences, and collaborate with a view to helping each other. Join us. Get in touch through the link in the show notes. I look forward to you joining me on the next episode.